Welcome to Alternative Solutions. Today we're going to take a look at some options for those people who don't feel that the offset mortgage is the best path for them. And the amazing thing about the magic of math is that even though 90% of people choose the traditional 30-year fixed route, there are actually several powerful ways to break free from mortgage debt faster. And today we're going to explore several of them. Each of these strategies can help you save thousands of dollars in interest and cut years off your loan when applied properly. So, whether you're considering the offset mortgage or exploring other options, you'll leave this lesson with concrete tools to accelerate your path to financial freedom. But before we dive in, let me be clear. There's no wrong choice here. Just like there's more than one way to get to work in the morning, there's more than one way to achieve mortgage freedom. So I'm excited about today's lessons because we're going to explore 6 other options outside of the offset mortgage that can transform your mortgage journey. So whether you're just starting your home buying process and deciding which route to take, or looking to optimize an existing mortgage, the best strategy is the one that matches your goals and situations. So let's get started with what I call the power play, the chunk method. Think of this like throwing big rocks into a pond instead of pebbles. The impact is much bigger waves. The beauty of chunking is its simplicity. You take larger sums of money and throw them directly at your principal. Maybe it's a bonus, a tax refund, inheritance, or side hustle money you've been saving up. But like all of our strategies, this is most suitable for people who have a steady base income and are willing to stick to their plan, aka their budget. And this strategy loves irregular income. So it's great for the commission earners, the bonus recipients, the business owners with seasonal windfalls. When money comes in waves, ride those waves to freedom. Now, here's your chunking playbook. First, plan your attack. Just like a football game, you need to know when those big plays are coming. Then you're going to identify your chunk sources. Is this commission checks, year-end bonuses, side gig income? Where are these sums coming from? Next, schedule those power moves. So mark your calendar for when those chunks are hitting. And finally, monitor your progress. Adapt and call new plays as necessary. Now, beyond the goal line lies massive interest savings, accelerated payoff, and more financial flexibility. If this is the option for you, get beyond the challenges to make it work. Aside from loan terms that might require you to be even more strategic, you can get results through this chunking method. Now, let's look at an example. So picture a $250,000 mortgage at 4% interest on a 30-year term, relatively standard. Now look at our chart and see what happens when you throw $10,000 chunks at it annually. Suddenly, that 30-year traditional loan schedule has become a sprint, a 13-year sprint. Now that's not magic, that's mathematics working for you instead of the bank. In this example, you would be saving over $107,000 in interest payments. Now, this strategy works great for people who have lump sums, but sometimes we can't find those really large lump sums. But when we look at optimizing our budget, we might be able to find, let's say, half of that. So even if the annual chunk was $5,000, you would cut this 30-year loan down to 18 years. And that's nothing to discard. Now let's look at what I call the steady Eddie approach, making extra payments. If chunking is like throwing big rocks, this is like tossing pebbles consistently. But don't underestimate the power of those pebbles. So there's 3 approaches to making extra payments. First is to simply apply a small amount, say $100 monthly, to your existing mortgage payment applied directly to principal reduction. Second, you can consider making bi-weekly payments. Now, this is a super powerful strategy and simple because anyone can implement it. It does not require finding or earning any extra money for payments. And third, you can consider making one additional lump sum payment annually equal to your mortgage payment. Now, this is generally achievable for most by using their tax refund wisely. So the biggest takeaway here is that these methods are simple and attainable, but be sure to prioritize those high interest debts first so that you can leverage that freed up money to our expedited payoff strategies. And even better if you can find a way to do both. But no matter which route you take, make sure the additional money is going to principal reduction. If you simply send in extra money to the lender, they will not automatically apply it. You must direct them what to do with those funds. Now, let's take a look at an example for making extra payments. So, look at the numbers here for our $200,000 mortgage. In our scenario where we add $100 a month, that's basically one less takeout night per week to principal, we will pay our loan off in 25 years and save $27,000 in interest. Now, that's a lot of takeout in the future. Now, if you look at the third bar on our graph, it illustrates making a single $1,000 lump sum payment yearly. In this instance, we're knocking off 4 years and saving approximately $23,000 in interest. Definitely not chump change. Now, while not illustrated on the bar graph, here is one of my favorite strategies. It's what I call the baker's dozen. You know how a baker's dozen is 13 instead of 12? Well, that's exactly what you're doing with mortgage payments when you switch to bi-weekly payments. Instead of 12 monthly payments, you're making 26 half payments. It feels the same in your bank account, but what happens in this method is that we're going to get the most out of our money and we're going to knock off 4.1 years just as we did by making an extra $1,000 per year. But the beauty of this baker's dozen strategy is that you didn't have to come up with any extra money to achieve that result. Now, lastly, the power of combining these strategies. If we took the biweekly plus annual lump sum, we would see remarkable results paying our loan off in just 22 years and saving a little over $39,000 in interest. Now, let's move on to the velocity banking strategy. Think of this as the DIY version of the offset mortgage. It's like creating your own accelerated payoff system using a home equity line of credit. Here's how it works. You use a home equity line of credit to make a large payment on your mortgage. Then you funnel your income through the HELOC, and then every dollar in that reduces your average daily balance. You're essentially turning your income into a debt fighting machine. Picture your HELOC as a really smart checking account where every dollar that sits there isn't just sitting, it's actively fighting your mortgage interest. Now, this system works best for either high income earners or two income households where there's a substantial free capital monthly to allocate paying off the HELOC, otherwise known as our home equity line of credit. Now, the primary benefit of this method over making extra lump sum cash payments is the ability to maintain access to your capital. To implement this strategy, you first need to set up a home equity line of credit or a personal line of credit for use. It's obvious, I'm sure, but make sure you shop for the lowest possible interest rate here because that is a key component and should not be overlooked. Then you will use the home equity line of credit to make a large payment towards your principal on your mortgage. This lump sum payment reduces the principal balance on the mortgage, leading to lower interest accrual over time. Similarly to the offset mortgage loan, you'll deposit your entire paycheck into the HELOC instead of a traditional checking account. This reduces the average daily balance on the HELOC, thereby minimizing interest charges on that line. Use the home equity line of credit to pay for monthly living expenses, effectively cycling funds through the line of credit. Now, you'll need to carefully monitor and track all your spending to ensure that you're staying within your budget and that you can make regular payments towards the home equity line of credit. Use any excess income after you've paid all your other living expenses to pay down the HELOC balance as quickly as possible. Once the HELOC balance is paid down, you'll use it again to make another lump sum payment towards the mortgage principal. So you'll continuously cycle your income through the HELOC, repeating the process to accelerate the mortgage payoff. So this concept is complex and it does require extreme skill to ensure you're not trading low rates for high interest rate debt. If not balanced properly, this method can backfire. But if used with lower interest credit line and cycled properly, it can produce very robust results. So let's take a look at this method in action. Let's say you have a $200,000 mortgage and a $50,000 HELOC at 6% interest. Then let's take a $20,000 draw from our HELOC to make a lump sum payment on our mortgage, and we're going to assume that we have $5,000 in monthly net income. You will deposit your $5,000 payroll check into the credit line. Every time your payroll check hits the HELOC, it's reducing your interest charges like having your money work two jobs. So now your HELOC balance is $15,000, but we still need to pay our bills. So let's say we have $3,000 in monthly expenses. Once those are paid, we leave the net income in the HELOC and we are now working with an $18,000 balance. So we keep repeating the cycle until the HELOC is paid off, then repeat the cycle again. Now, finally, let's talk about what I call the optimizer's dream, the credit card strategy. Now, this one comes with a really big warning label. It's like a high performance sports car, powerful in the right hands, but you need to know what you're doing. This strategy involves finding and using 0% APR offers strategically, making lump sum payments to your principal, and paying off the card before the promotional period ends. So the first step is to find the right credit card. Look for a credit card that offers a 0% introductory APR on purchases or balance transfers for a specified period. This is usually 12 to 18 months. Also ensure the card has low or no balance transfer fees and reasonable ongoing interest rates after the introductory period. A simple Google search will reveal these providers. Just type in zero interest credit card offers and you'll see many come up. And double bonus points for finding a card that also has a good points reward system. Now, you'll also need to access and understand your mortgage lender's policies. Confirm if your lender accepts credit card payments directly because many lenders do not, but there are workarounds such as using a third-party pay service. If your lender does not accept credit card payments, services like Mesa or other companies that do payment processing allow you to pay your mortgage with a credit card for a fee. So be sure you evaluate these fees to ensure the strategy is cost effective. Once you have the details, calculate the savings and the risk. First, start by calculating the potential interest savings by paying down a portion of your mortgage principal using a card. Develop a clear repayment plan and follow it to ensure the credit card balance is paid off before the end of the introductory period to avoid high interest rates. Obviously, you're going to make the payment, so you'll use the credit card to make a lump sum payment towards your mortgage principal via direct payment if allowed or through a third-party service. Now, keep track of the balance on your credit card and ensure that no interest debt accumulates. Meaning, if you can't pay this balance, do not use this method. Now, you're going to pay off the credit card balance. Make consistent and timely payments on this card to pay off the balance within that 0% APR promotional period. We do not recommend using this credit card for other purchases that could lead to an outstanding balance and high interest charges. So these benefits are consistent with the theme of our course, but the risk should not be downplayed. If the balance is not paid off within the promotional period, high interest rates can negate any savings, and balance transfer fees can also reduce the overall benefit. So, this requires strict financial discipline to manage and avoid additional debts. So, let's look at how this strategy can work. So, first, we're going to calculate the transfer fee. In this example, the transfer fee is 3%, and we're doing a $10,000 draw. So, 10,000 times 0.03 is $300. Then we're going to use that credit card to make our $10,000 payment towards our mortgage principal. The $10,000 payment then reduces the principal, saving interest over the remaining loan term. 4, we're going to plan to pay off the $10,300 within 18 months or whatever the promotional period is to avoid high interest charges. Now, when you pay off the credit card balance, you'll repeat this process. The results by consistently applying this strategy and making a $10,000 extra payment every 18 months, you could potentially pay off your mortgage in about 12.25 years earlier than with regular payments. So, in the end, you would pay off your 30-year mortgage in about 17.75 years and save about $60,000 in interest. But remember, this strategy requires ninja level financial discipline. So the goal isn't just to pay off your mortgage faster, it's to create financial freedom on your terms. So whether you're that person beginning your buying journey or someone looking to supercharge their path to freedom, there's a strategy here that can work for you. So here's what I want you to remember. The chunk method is perfect if you get periodic large sums of money. Extra payments can work for almost everyone, especially our biweekly method. Velocity banking is like creating your own offset mortgage, and the credit card strategy is for advanced players only. But here's the most important thing: you don't have to choose just one. The most successful clients will likely combine these strategies. Maybe they make extra monthly payments and use their annual bonus for chunks. Or they use velocity banking while building up their qualifications for an offset mortgage. Or they combine biweekly payments with extra monthly or annual payments. Any of these strategies are going to be a powerful tool in your tool belt. So before our next lesson, grab your workbook. We have a strategy calculator waiting for you. Run your actual numbers through each method and pick the approach that feels most natural for you. But most importantly, take action. Remember, while the offset mortgage might be the most efficient path forward, these strategies give you powerful alternatives. Whether you're working towards offset qualification or simply prefer a different approach, you now have a full toolkit for accelerating your journey to mortgage freedom.